Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And we begin in North America. After months of brutal economic numbers, is Canada finally getting some good news? Canada's economy staged a stronger than expected rebound in the third quarter as surging housing activity and a jump in government capital spending more than offset the lingering damage from the trade war with the US south of the border. Gross domestic product expanded at a 2.6% annualized pace, Statistics Canada reported over the weekend, the fastest quarterly growth in nearly a year, and a sharp reversal from the 1.8% contraction recorded in the second quarter. The performance far exceeded forecasts from the Bank of Canada and private sector economists, who had expected growth of roughly 0.5%. Markets reacted modestly. Government bond yields edged higher across the curve, while the Canadian dollar strengthened to its highest level since late October. Traders continue to anticipate that the central bank will hold policy rates steady at its 10th of December meeting. The composition of growth underscores a significant shift in Canada's economic drivers. Residential investment rose at a 6.7% annualized rate, powered by a resurgence in housing resales. Even more striking was the 12.2% jump in government capital expenditures, led by Ottawa's purchases of River-class destroyer warships, the largest share of military systems in government investment since the late 1980s. That is, the end of the Cold War. These details are important as it suggests that this good news is more short-term, as this sort of purchasing will not continue indefinitely. And indeed trade, the more sustainable growth driver, as it's tied heavily to manufacturing and commodities exports, remained the weak link. Exports grew just 0.7% following a historic 25% plunge in the previous quarter, with US tariffs imposed by the US President Donald Trump battering Canadian shipments. Gains in crude oil provided some support, but overall exports remained far from recovery. Imports fell 8.6%, the steepest drop since 2022, driven partly by a pullback in precious metals shipments. Indeed, beneath the upbeat headline figure, underlying domestic activity looks soft. Final domestic demand slipped 0.1%, while household consumption fell 0.4%, the first decline since 2021, the pandemic era, as elevated unemployment and waning confidence weighed on spending. Businesses also remained cautious. Non-residential investment dropped for a second straight quarter, and firms ran down inventories by nearly 4 billion Canadian dollars amid broad pessimism. Economists warned that the momentum will likely not last. A preliminary estimate shows industrial output contracted 0.3% in October, signaling a weak handoff into the final quarter. Even so, fiscal and monetary support continue to underpin key sectors. Prime Minister Mark Carney's multi-billion-dollar military commitments and the Bank of Canada's mildly stimulative 2.25% policy rate point to ongoing strength in housing and defence investment. As CIBC economist Catherine Judge noted, despite the noise, the data, quote, cements the on-hold story, end quote, for the central bank in December. Next up, Switzerland has decisively rejected a proposed 50% inheritance tax on ultra-wealthy residents, quashing a left-wing initiative that opponents said threatened the country's economic model and global appeal to high-net-worth individuals. In Sunday's national ballot, 78.3% of voters opposed the measure, which failed to win a majority in any of Switzerland's 26 cantons. Turnout reached 43%. The finance minister hailed the result as a strong endorsement of fiscal stability. Quote, voters have clearly rejected a risky fiscal policy experiment, end quote, she said, arguing that such a tax would have upended Switzerland's finely balanced tax system and undermined its attractiveness to wealthy residents. The proposal, launched by the Young Socialists, had sought to introduce a 50% levy on all inherited or gifted assets exceeding 50 million francs, $62 million US. Supporters framed it as a tool to raise funds for, quote, climate change initiatives and address wealth inequality, end quote. Roughly 2,500 individuals, the richest 0.03% of the population, would have been affected. But opposition was broad and intense. All major parties, except those on the left, campaigned against the measure, warning of a potential exodus of wealthy individuals whose tax contributions underpin many cantonal budgets, perhaps showing more fiscal wisdom than voters in neighbouring France have in recent months. Among the most vocal was the billionaire industrialist and top shareholder of Sattler Rail, who said he would relocate if the tax passed, arguing it would ultimately force the sale of his company upon his death. Switzerland, which already levies cantonal wealth taxes, has long been a magnet for global millionaires and billionaires. A UBS study shows the country hosts more than 9 billionaires per million inhabitants, 5 times the Western European average. Preferential tax arrangements for affluent foreigners and investor-friendly policies have reinforced this appeal, advantages that many voters appeared reluctant to jeopardize. Local officials from wealth-dense regions such as central Switzerland reported that residents were already considering departure during the debate, underscoring the perceived risk. The result helps ease concerns that Switzerland's status as a global wealth hub could be slipping amid growing competition from Asia and the Middle East. In keeping with Switzerland's tradition of frequent referendums, voters again sided with business interests, showcasing that they understand the importance of a thriving business environment and that wealthy individuals already pay a very high share of the nation's tax. Local voters in Freiburg rejected a 23 franc minimum wage, while a separate national proposal to expand mandatory military or civilian service to women garnered just 15.9% support. Next up, we move to Asia, but just quickly, if you want to continue to be on top of updates like these, consider subscribing to Market Update, and if you're getting some value from today's episode, it's a huge help if you can just hit that like button. Taiwan has sharply upgraded its economic outlook for 2025, projecting GDP growth of 7.37%, its fastest expansion in 15 years, and an incredible rate for a developed economy, as the global surge in artificial intelligence technologies continues to supercharge demand for the island's electronics exports. The bullish revision follows a standout performance in the third quarter of this year, when real GDP grew 8.21% year-on-year, according to new data from the Cabinet Statistics Agency released today. The agency said the economy benefited from a 32% jump in exports, driven overwhelmingly by orders for AI-related hardware and consumer electronics. The third quarter result came in 0.6 percentage points higher than last month's forecast, marking Taiwan's strongest quarterly performance since the second quarter of 2021. That earlier surge was powered by pandemic-era laptop purchases and a global chip shortage that lifted semiconductor exports. If achieved, the new full-year forecast would see Taiwan grow much faster than mainland China, an unusual dynamic for a highly developed economy, and a feat which one commentator called a humiliation for Beijing as China's economy slows and faces acute structural issues, and as cross-strait tensions continue to escalate. Part of China's wider strategy includes a narrative war in which it attempts to paint mainland China as having a superior system to Taiwan's. With Taiwan, already an advanced economy, growing so quickly as China slows and faces all these challenges that will be all too familiar to regular viewers of my other channel, China Update, this is fast becoming a difficult narrative to push. At current forecasts, GDP in Taiwan would rise at its fastest pace since 2010, when Taiwan rebounded from the global financial crisis with double-digit growth, taking that 2010 year out, and it's the fastest growth in decades. Much of this momentum stems from Taiwan's commanding position in the global semiconductor and electronics supply chain. Taiwan Semiconductor Manufacturing Company, TSMC, the world's largest chip maker, produces more than 90% of the world's most advanced chips, while Taiwanese manufacturers dominate production of AI servers, laptops, smartphones, and a vast ecosystem of components. Companies including TSMC and Foxconn say demand for the server infrastructure that underpins AI is not only holding up but accelerating, even as some global investors warn of a potential AI bubble. While the government acknowledges an uncertain macroeconomic environment, particularly around US tariff policies, and of course the ongoing tensions in the Taiwan Strait, the Statistics Agency still raised its forecast for 2026 growth to 3.54%, up from 2.81% 3 months earlier. It said, quote, "Long-term momentum in AI technologies and related applications is becoming increasingly entrenched," end quote, noting that many governments are now promoting sovereign AI strategies, further boosting hardware demand. Taiwan's deeply integrated and highly competitive supply chain's position is to capture much of this growth. However, the electronics boom contrasts starkly with slower moving segments of the domestic economy. Traditional industries continue to suffer from global overcapacity, and real private consumption rose just 1.19% in the third quarter, underscoring uneven demand at home even as exports surge abroad. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Monday, have a productive week, and I hope to see you for another episode tomorrow.